Hey everybody, welcome back to Drawbridge Finance. Today I'm going to show you an amazing spreadsheet I built that compares mortgage payments to investment returns. As always, welcome back to the channel. My name is Levi Woods. This is Drawbridge Finance. This is an opinion channel about money. I'm not offering financial advice. I don't work in the finance industry at all. But as you guys know, I daily trade. I'm an options trader. I'm a long-term buy and hold dividend, high yield dividend investor. And I have this channel to help people make more money. That's the goal of my channel. So if you guys haven't subscribed already, make sure you hit the like button down below. Hit the notifications bell and subscribe. Do those things so that you get these updated videos so that you can follow along on my journey to wealth creation. Anyways, today I'm going to jump right into this. I built this chart that allows me to easily compare a mortgage scenario compared to an investment scenario. And it's really quite basic because what it allows me to do is alter the amount of the loan, of the mortgage loan, the interest rate, and the term of the mortgage up to 30 years. And then I can put in an extra monthly payment and it will automatically give me the two scenarios, how much money I would make if I put that money towards my house or if I put that money towards a long-term buy and hold dividend investment. Now, as you guys know, if you've been following my channel for a while, you've probably watched some of my other videos on why I'll never pay off my mortgage and how much money you can save by putting extra payments towards your mortgage. Now, I am definitely not an advocate of putting my money towards my mortgage because I personally have a really low rate. My mortgage is 3.64%, and that is extremely low. So it's easy for me to make a better return on the stock market. And this chart that I've built, it shows exactly how much money I can make to see a difference in my personal situation. Now, a lot of people claim that we can't make a 7% return, and of course, I have proven that wrong time and time again. I've done tons of videos on this. I'll put a link right up here if you guys are interested in seeing another video on how to make a 7% return year after year after year, and it's why I always use 7% as my benchmark. So when you open up this document for the first time, I've set the loan amount for $200,000. The interest rate is 3.5%. Now, this would be fixed for the whole term. Now, I know not all of you have fixed rate mortgages. I live in Canada, so of course we have to renegotiate our contract every 5 years, and so we're at historically low interest rates now, and that's why I'm choosing to invest rather than pay off my mortgage. Now, that said, these last couple months I actually have been making some extra payments because we just bought a new house in October, so it's only been about 8 months and we've been making a few extra payments because we know that we get absolute guaranteed return on investment of 3.64% if we put any money towards the principal as an extra payment towards our mortgage. Now, that said, I'm not going to do that for very much longer. Really, this first year, one of the major reasons that I have been putting money towards my house, my mortgage payments, and not towards the stock market, my extra funds, it has nothing to do with the mortgage at all, actually. It has to do with the stock market. We're at all-time highs, and the stock market's been going up and up and up. And I'm fearful, as with many others, that we're going to see a major recession. So I don't want to be putting money at this point in time into the stock market, a ton of extra money. I'll continue to put some in, but not all of my extra money. So I am choosing right now to split some of it, put some towards my mortgage and some towards my investments. And these charts will help you guys determine whether or not that's a good choice for you or whether or not you want to continue to put money payments towards your mortgage completely. So the first thing we're going to do, we're just going to roll through this. We're going to look at the top section here. This is where you enter your data. Now, all of the data gets entered in the white cells. So on this first spreadsheet, there's actually only 6 cells that we can enter data, and that is the loan amount, the interest rate, and then the term. So as I said before, mine was 3.64, so I can just modify this to be 3.64%, and it will change the data. Now, a monthly payment also changes. So if I had a 25-year mortgage, I would put in 300 months here instead of 360, and that would change it as well. Now, the extra payment, we can put it at 0 to see what happens. If we make no extra payments, full-term mortgage is going to be $304,897. There's 3 different scenarios that are proposed in this chart. So the first one, A, is where the mortgage payment, any extra payment that you put in this box, this monthly payment, goes towards the mortgage principal until such time that the mortgage is completely paid off. Then the total that you would normally put towards your mortgage plus that additional money goes now into an investment to see how much money that investment can generate over a 30-year period. All of the numbers in this net worth column are over a 30-year period. In scenario B, there would be no extra mortgage payments made. We'd just pay the mortgage as scheduled. We'd take our extra money that we're putting into this white box up here, the extra monthly payment, would go towards the investment. And at some point in time, that investment is going to be worth more than the value remaining on the mortgage. And this allows us to see which one is sooner, relatively easy. The third one is a custom chart. Now this is for people that are midway through their mortgage and they want to just go through and plug in the numbers past or future that they think they want to do. And you can split it up. I'll show you guys that a little bit later, but you can have entries in either extra principal payment towards the mortgage or as an entry towards the investment. Or you could do both. You could do like $100 to the investment and $100 towards the mortgage. And you can play with that scenario and see how much money gets made theoretically over a 30-year period. Of course, these are average numbers that we're looking at in a chart like this, and it does not account for inflation or house value increase. I mean, really, the house value doubling or tripling over 30 years has nothing to do much with how much you owe on it or how much you saved on your mortgage. So I don't include that in this type of chart at all. So let's just plug in $100 as an extra payment and see what this does. So it changes it from the net worth. Obviously $100, you've put in a lot more money, over 360 months, you've put in an additional $36,000. So of course, the value before was a $200,000 loan value that you've completely paid off. So that becomes part of your net worth. And then the addition is the amount of income that you made off of that additional money that you put in. So the $36,000 generated $55,000 in income. So you have this total of $291,000 in scenario B where you put the money towards the investment. Again, this is why I built this chart, because it shows that putting $100 towards an investment that pays 7%, even when it's taxed at 21.5%, which is the absolute maximum we can pay on dividend paying income in Canada. In the States, I believe it's even lower. So you'd have to figure that out yourself. But if you were to put this money, $100 bucks a month, which is only $1,200 a year, that's well below the threshold of an IRA, like a Roth IRA, or a TFSA, or an ISA if you're in the UK. Theoretically, this could easily be a 0% tax rate, in which case those numbers are going to change even more. The $36,000 extra that you put in is going to generate $86,000, giving you a total wealth of $322,708 compared to paying down your mortgage and then trying to catch up with the investment. Now, of course, everybody's going to say, well, 7% return is impossible. So let's just change this to 4%. So maybe that's more realistic for someone. Of course, the 4% in the investment is greater than the mortgage rate at 3.64%. And when we put our money towards things that pay a bigger percentage, they make more money. That's just simple math. You can't argue with that. So when we look at this outcome again, as long as this investment return is bigger, minus the tax, then the interest being charged, then the outcome will be greater. So in this case, the person that invested rather than paying down their mortgage made more money. Not a lot, to $269,000 compared to $266,000. So it's only a $3,000 difference. Over 30 years, not very much money. And everybody always wants to know, well, when can you actually pay off your mortgage? And you can see that right here in scenario A, you'd have your mortgage paid off 41 months earlier. And if you put the money into the investment, you could theoretically have enough money to take that investment and pay off the mortgage in full 42 months earlier. So actually a small win. Now, if this goes to less, if you're investing in like a 2% bond or something like that, then obviously the person that invests makes less money than the person that pays down their house. So really, this chart has everything to do with these two numbers. What is the mortgage rate and what is the return on investment minus the tax? So I'm going to change this back. So 21.5, I'm going to go 7 and 3.5 and 360. And this is on the summary page at the top. You can see there's actually 4 pages. This is in numbers. If you guys are using Microsoft Excel, there's a version available of that. It's down in the bottom but there's a couple spreadsheets in here. So the first one is going to be A, and it's going to show you all of the payments, exactly what happens. It shows what the normal payment schedule would be here, and then this is the scenario that we're running. So we have our normal payment would be $898, and in this case we would be making that payment of $898, and then the additional payment of $100. The payment's $898, $583 goes to interest, $314 goes to principal. It reduces the balance down by this amount, so $200,000 minus $314,000. In this scenario that we're running, same $200,000 balance, the payment goes through of $898, an additional payment of $100 applies directly to this principal portion. So the interest is the same, $583 and $583, and the principal is greater by $100, so $314, and this one's $414. So the balance owing is decreased by $100, so $585 compared to $685. What that does is it decreases the interest in the following month. So without making that extra payment, in the second month, the interest would be $582.42, and this would be $582.12. Not a big difference now, but it makes a huge difference further along. Now you'll notice that there's this column is red, and as you scroll down, it becomes blue. And what all that's showing is that any time that the principal portion is less than the interest portion, when this payment goes through, $898, more than half of it is going to interest. At this point, the interest has become lower, so the principal portion is getting paid down faster than the interest. And that's really the secret to paying down a mortgage, is getting to this point where when we make a payment of $900, most of it goes to principal and not interest. So making that extra payment is a huge deal. Now, of course, in this scenario, there's no money going into the investments. And so then the net worth calculation on here is the addition of the balance owing minus the equity, because you've bought a home worth $200,000, and then plus the investment number. So it's the $200,000 loan as equity minus the amount owing plus the investment value. So what's going to happen with this is, because we're making this $100 payment, we know that we're going to save $22,000 in interest by making all these payments. And when we scroll down here, in month 302, we make our final mortgage payment. So our mortgage is paid off 58 months early, which is 5 years. That's pretty substantial to pay it off that early. Automatically, the investment column starts to populate. So we take that remaining money that we normally make this $1,000 a month payment, 900 plus 100, and we're going to take that 519 plus 479, and we're going to put it into an investment, specifically into an investment that's paying a dividend of 7%, and we're getting taxed at 21%. And that can all be adjusted back on the summary page. So what's going to happen now is that this is going to start to grow. We're going to start to contribute $1,000. We can see some totals here. We can see total amount paid. We can see the total amount of extra payments, the interest portion. So the total interest paid, the interest saved, the regular mortgage payments. So this 300 is the 270 plus the 30. We've paid off earlier by 58 months, as I said before. And we've got the principal portion is paid down to zero. So this original $200,000 loan is worth $200,000. We owe zero here. And the investment contribution, we've put $58,000 in there. The dividends returned have been $11,000. We've paid $2,300 in tax. So we have a total investment value of $67,000. So the after-tax dividend income is around $8,600. That's the dividend payout minus the tax. That's how this number is calculated. And the investment contributions are $58,368 here. So the total net worth, $267,000. And we can see how those numbers are generated. So this is just an analysis of what's actually going on to generate these numbers. Now B is exactly the same. It just has the $100 going towards the investment rather than the mortgage. And then we're going to see when the investment value is greater than the mortgage value. So looking at the top, again, we can see the same scenario. This gray column did not change at all. The difference here in the mortgage column is that there's no $100 extra payment. Instead, the $100 is going into the investment over here. So we're still paying monthly the $898 plus the $100, so around $1,000 a month. And instead, we're collecting dividends right away. So $100, the dividend gets paid 58 cents. 13 cents goes to tax. This is because of the 21%. It would be zero if it was in a tax sheltered account. We would have $100.46. Then we would add another $100 to it. We would collect the dividend of $1.17, pay the taxes, and end up with $201.38. $100 in plus the dividend minus the tax, $302. So you can see how that works. So in this mortgage column, we are definitely paying more interest, but that's okay because the investment over time is building more income. We scroll down and we look at this, and right here at month 287 is when the investment value is worth $59,467, is exceeding the value at $58,978. So that's why this has gone green at month 287. Now you can remember the last chart in chart A was 302 months. And now, of course, at the bottom, it shows us the totals again. So the payment amount, $322, 0 extra payments went to the mortgage. The interest portion, we paid a lot in interest, $123,000 in interest. We've had 0 saved interest. We've paid off the same $200,000 that we owed, so we owe nothing. But the investment put $36,000 in, and the dividend payout has been $70,000 and then $15,000 in tax. So again, had this been in a tax-free or tax-sheltered account, that wouldn't be in there, and that would actually be greater. So the after-tax dividend income has been $55,000 on top of $36,000 investment. So that's where we get this total $91,000. Total money in plus the dividends collected, reinvested, minus the capital gains gives us total value. So this 291 is the $200,000 equity in the home minus the amount owing, which is a 0, plus the $91,000 the investment is worth. That's where we get this number 291,693. So total net worth of 291. These charts just show all the details of what is on that summary sheet. You can play around with those numbers and see exactly what your rate of return or what your mortgages would work, and to make these numbers work and when it would actually be. Now the third chart is really custom. There's only a couple of entries that you can do. So the numbers in this top left corner are pulled from that summary sheet. So the only thing you can do is enter money in each individual month. So you can just put in $100 here, and you can say, okay, well, what happens if I put $100 here and I put $100 here? Or maybe I want to alternate. You can do custom things. We can even take a withdrawal. Like say there's $1,600 in here, we could put a minus in here of $1,000, and we could apply that money to our mortgage instead on this side to see how that scenario might affect us. So even with these simple things, a couple little payments, scroll down to the bottom, you've got 360 months to play with. In this scenario, we've paid off the mortgage 3 months earlier, or we had enough money to pay it off 6 months earlier, depending on what we're looking at. And again, this is all dependent on this rate of return. So if the investment is returning greater than the interest rate on the mortgage. Anyways, that's it for today's video. There's a link down below for you guys to download it. You can download it either on my Patreon account from my paid patrons or on my Etsy store as an individual purchase. I hope you guys enjoyed this video. I hope that this becomes a useful item in your arsenal to getting rich. And let's get rich together. Thanks so much. See you very soon.